Howdy, Jacob here. Today we're looking at Ardmore Shipping Corporation, and they are in the oil, gas, and consumable fuels industry. They engage in the seaborne transportation of petroleum products and chemicals worldwide. Company was founded in 2010 in Bermuda. Okay, humongous growth, over 10 times revenue in the 10-year period. Margins are actually down on the gross margin side, 57% now, 70% 10 years ago. But operating margin is now 36% while being negative. Very cyclical business. I see 3 years that were negative operating margins and then a few that were well over 10%. So kind of all over the place. They're currently paying a dividend of $1.15 or 7%. And it looks like when times are good, they pay a dividend, and then when it's not so good, they don't. So the dividend you can't really rely on. And this return on invested capital looks substantial, but that's because it was their highest earnings per share by an astronomical amount when you look at the past here. But market cap and enterprise value are both essentially the same, so that's great to see. Just under $700 million. They have 116 million long-term debt, 13 million short-term debt, and then 51 million cash on hand. So pretty fair amount of cash on, or a fair amount of cash on hand for the debt that they have, yielding a net maybe 60 mil, and it looks like that's pretty reasonable for them. They've actually had some devastations in 2021, 2022 on the capital expenditure side. So, I mean, it's positive that they have reduced their capital expenditures. Something must have happened between 2016 and 2017 for them to do this, which is great for them. And their use of cash really has been going towards debt recently, so that's cool. And then a dividend, just because they have a lot of cash. I mean, it looks like historically the return on invested capital was not very good. So I guess it's fine that they're just paying a dividend because they might not get the best return on them reinvesting back into the business, historically at least. But interesting that they haven't found their stock cheap to buy back, which, I mean, there's nothing wrong with that. If you don't think your stock's cheap, then don't buy it. But to me, I want the capability of buying back shares that are stupid cheap. But maybe it's not cheap, so they haven't been buying it. So it looks like they've really just been paying down debt and paying out a dividend for use of cash flow that they do produce. Nothing wrong with that. I think I'm ready to make some assumptions here. So I would say this growth, I just don't see it sticking. So I'm just going to do no growth and then 10p price free cash flow for a no growth business. I mean, their margins are all over the place. So I'm just going to be doing a super wide range average here just because I don't know what it's going to produce. And then they have been, like I said, not buying back any shares and then issuing shares through stock-based compensation, and then also issuing a little bit of shares to fund some things, which is interesting for how much cash they're producing. And so I'll probably say 3% a year dividend. 44 million, I think on an average year, they're not going to be able to afford that. So let's bring that down in half and say they average about 20 million. Still seems like a lot, but they're making 180 million free cash flow in the rolling 12. So pretty substantial. I would say that it's probably going to average out to something close to this. So I feel comfortable with all of these. I would say that I know I'm being conservative since the fact on revenue they've over 10 times it in a 10-year period, but I just don't see that growth going into the future based on the fact of, like, if you just look at this 5-year period between 2017 and 2021, there was actually a slight decline in business. And so I'm assuming no growth, and then for no growth businesses, and I'm assuming essentially no growth after 7 years, a 10 on the PE, price free cash flow. And again, we get, with my assumptions, get to a price needs to fall 65%. Surprisingly, although this isn't a high ROIC screener, there's not enough powerful history of, gushing cash flow and gushing return on invested capital to where I'm interested. And their use of cash flow is interesting, and just paying down debt and paying out a dividend makes me think that even the company doesn't think that their return on invested capital that they, or the money that they would reinvest back in the business would be the best for their shareholders. So to me, just wait. It needs to fall quite a bit more before I'm more interested. Hopefully everyone enjoyed the video. Thank you.